Welcome to session number 3. We'll have fixed income and commodity. My name is Leticia Velasquez. I am a CAM alumni from Rice, and thank you for the invitation to lead this session. So our first speaker is Max Lee. Max Lee graduated from Rice University with a Bachelor's of Arts in Mathematical Economic Analysis in 2014 and a Master's in Statistics in 2015. He also has a Master's in Information and Data Science from UC Berkeley. And he's currently a director at Bank of America Securities, leading the global commodity and FX systematic strategy and index trading team. And he's developing tactical and systematic hedging strategies on both intraday and intraday basis. So welcome, Max.
Okay. Well, thank you for the introduction and the opportunity to be here. As mentioned, my name is Max, and I run the FX and commodity sort of II and systematic strategy team for B of A. We focus on commodities and FX in particular, but we have counterparts across the world that work in credit and rates and equities. Globally, my team has traders in Singapore, Paris, London, and New York that all work to help manage a $40 to $45 billion franchise. It covers 45 or more commodity markets, 31 FX currencies, and then all the combinations of that. And it transacts daily at all points on the curve and trades derivatives that range from your Delta 1 vanilla futures and swaps all the way to some of the more complex exotics and nonlinear structures. So I've been at the job since I graduated here about 7 years ago. So there's a little bit of personal bias probably, but I do think that it is a unique sort of mandate, not just at B of A for all the trading desks, but as well on the sell side, you don't really see that ability to cover as wide a universe. You get a lot of silos. And so I think hopefully we can share a little bit of that experience, give a very quick high-level introduction to FIC and commodities and sort of systematic strategies, and then maybe a little bit about where we see kind of the frontier being pushed. Okay, so when I think about alternative markets and sort of asset classes, I'm generally thinking about anything beyond that X and 1 minus X core bond and equity portfolio, which makes up so many of people's allocations. So if you take a step back and think about why do people invest, which is, I think, fairly important, a broad claim could be reasonable that stocks provide long-term appreciation and bonds give you the cash to meet your needs, your operating expenses, whatever it may be. And so then if you go one step further then back to the analysis, you see that those portfolios probably perform not just as a function of whatever it is that you were hoping to capture in that idiosyncratic selection, right? And so another way to say that is that you could have something that is well diversified, structured correctly academically and traditionally, whatever it may be, but it has these thematic macro exposures like rising interest rates or adverse currency selections. And so as financial markets and technology have made drastic gains over the last decades, you've seen kind of the evolution of these mature sort of investable asset classes, right? And so commonly, I think the common vernacular for this, at least on the sell side, is FIC, which stands for fixed income currencies and commodities. And so I'd make the caveat that the fixed income side is probably a little bit broad and could probably be broken down into something more like credit rates, sort of government, backed bonds. But so that is what we cover, and I think. It's been something that is sort of underappreciated about the markets is that you get so much coverage of equities, and we actually designed a course for this last semester. But you get so much cover of the equity market. It's what everyone does in academia. It's what people have in their 401k. But the reality is that I think the capitalization of the equity market tapped out somewhere before this last sell-off around 120 trillion maybe globally, and in totem. The notional and sort of the daily traded components of the FIC markets, eclipse that by massive amounts. And so just if you think about, the FX swap markets, that trades, right now roughly between, $5 to $7 trillion a day. So I think there's a large amount of opportunity, and it's been something that has been very in vogue, obviously, with the environment of inflation, rising interest rates, and commodities, especially in the last 2.5 years. And there's a lot of opportunity, I think, for people in quantitative, finance professionals or students to sort of add a lot of value. And I think hopefully you see that it is an exciting space. Um, Go to the next one. So it's very high level about what it is we trade, and we can go much more into that if we have time. But I think another important component is like how is it traded, and so in my particular world, we look at a very specific form of capital deployment that is this kind of risk premium sort of factor modeling. In the vein of sort of increased liquidity and I think more and more efficient markets, there's probably been an industry focus or sort of a move in the industry to focus on the cost per unit of return, how transparent that return is, how persistent could it be, and so factor investing, which is the idea that you can effectively try to assign the structural buckets of return and risk that persist in a market and try and take advantage of those in some quantitative way, has become very in vogue, not just in long only forms, but for long shorts, obviously, in your total return. And it has been something that is very prevalent on both the buy and the sell side. So this is a fairly a very sort of high level flow diagram that's from our friends at the CME. But what it sort of shows is, how do you start approaching a portfolio or sort of an asset allocation, and thinking back to that commonality of why do people invest? That's obviously the first step of what is the purpose of the strategy, right? Is it to give access beta, which is the idea of long only exposures? So in the commodity market, that can be something as simple as your farmer in the Midwest that has exposure to corn, or an endowment, right, that has foreign equities exposure, and maybe looking to do something about the yuan, maybe in China. And you can sort of move all the way down, right, to the idea of enhanced beta, which is can you mitigate or do something a little bit better than that benchmark? Alpha, which is as simplest form as kind of enhanced minus regular beta, but is an idea of sort of long short sort of total return vehicles. And once you have that mandate in place, then the idea is that you can sort of layer in ideas and sort of portions of diversification, right? You start with what it is that you're looking to trade, across asset classes, across geographies, across signals. And then you can get even more complex about, how do you weight those signals, or how do you add value once you sort of have the standalone alpha veins. And so something that I think is a important nuance is that the systematic approach tends to, I think, be accompanied with a little bit of a reduction of domain expertise. And so what I mean by that is that if you go out and you work as a macro quant trader, you will likely never know as much about the oil fundamentals that sort of go into maybe, let's say, one part of your commodity strategies as an analyst that is there to count the barrels, monitor the ships. And I think that brings somewhat a little bit of a paradox in that we're talking about markets that are more macro driven, more supply and demand oriented, probably than equities. And so it doesn't make sense that I'm here saying that there are hundreds of billions of dollars that follow a strategy type that is honestly mostly mathematic, mostly statistical, and honestly sometimes not even very complex. And honestly, the answer is that it can, in sort of a very short summary. So what you have here, outside of some B of A propaganda at the top, if you look at the bottom, is a construction of 5 very simplistic sort of versions of these factors, like we said, carry value, which everyone's probably heard of, specifically geared toward the commodity space, since that was a little bit of the bent of the session. And you can see that it generates individually return, and then if you put it into the context of a little bit of a levered basket, it can generate substantial returns versus an asset class that is flat to unch. And so I apologize that the results here are a little old, and that was helpful to get some compliance sign-offs, because these are actually live strategies that people do invest in. But what you do get is you see a decade worth of data, of which I believe 2 to 4 years of almost all of them are sort of live out of sample. And what you find is that you do that little bit of a combination again with a little leverage, you get very good risk-adjusted returns, low correlation to the S&P, which is again thinking about that core portfolio, and as well as a low correlation to the actual asset class, which was negative through all sorts of macro environments in this period, right? You sort of end coming out of 2009 with the tail end of the global financial crisis, and then all the way through sort of Trump era politics in 2019. So it's proves to be a fairly effective way, even if it is a little more laden and sort of focuses on that mid to long term investment horizon. And I think the one other thing that we kind of wanted to highlight here is that, and this is not specific just to commodities, but it also, I think, generally describes the FIC market space well, is that you have a benchmark that is not kind of an upward drift, right? It can be tough at times to outperform something that makes 10%, 15% a year. Obviously this year is still TBD, but you have that benchmark that I think can be subject to a lot more value add, when people can come up with, clever ways of doing things. And so that's one of the things that's true, not just in commodities again, but if you think about the dollar, right? The dollar doesn't universally appreciate every year. So that's kind of where we spend a lot of our time. So that is kind of like the summary of what I do, and so the market as we see it standing. And then, in the vein of kind of frontiers, we wanted to sort of take those 2 points of like what it is we trade and how we trade, and sort of go through a little bit of where we see maybe the future going. So one of the competitive advantages I think about commodities and the future space especially, but you also see it, as mentioned, some of the crypto work being done in FX, is that there is an ability, I think, to sort of give derivative complexity and access to new markets in a much more sort of adaptive and sort of innovative way than arguably in your core sort of stock portfolio. And what I mean by that is that this is probably going to be a dramatic oversimplification, but if you have the idea that a share is a share, and that yes, the stock that you might be looking at does something innovative and brand new, but at the derivative level, it is still representing something that it has some commonality with all share ownership. Versus here, especially if I think about some of the work being done, here, since it's talking about commodities, like in the ESG space, for example, which we had the great presentation on earlier. ESG is a massive investment mandate, right? And sort of a major theme for all sorts of investors across the buy side, the sell side, the corporate, and as well as I think the start of some retail. And what you see is that one of the more the direct ways that people are looking to manage that is to either trade carbon offsets or emissions. And so like EUAs traded out of Europe, right, is probably the most liquid at the moment, as well as put direct investment into, I think, green energy and sort of green metals, especially like cobalt, your lithiums. And so what you see is this kind of surge in investment in sort of looking for infrastructure to actually access and trade these markets, and where the exchanges have done a great job is sort of start to offer that and trying to find ways to allow people to put their capital to use in, and something that is a meaningful size both economically as well as in terms of the mandate or return. And so in that vein, ICE, which is the Intercontinental Exchange, is probably the main location for some of those global carbon trades when you think about EUAs, CCAs. But our friends at the CME were actually the ones that were kind enough to put this sort of visual together for me. And so what this is supposed to highlight is, the upward trend in kind of the last 7 months since they listed their global emission offset suite. It's not something, I think they first started about 7 months ago. And the actual granularity of the data probably doesn't matter that much to you guys, but what I'm hoping the takeaway is you see this very consistent sort of bottom left, upper right tracker of all traditional measures of investment and liquidity in a space that is fairly brand new. And it's not just limited to carbon, right? I mean, this is happening. They can do things in weather, in water. They listed a whole set of new crypto real-time indices as well. And so, I think that it's an exciting time, and honestly, like the rate at which we're seeing sort of access to new markets that are, I think, fundamentally very different, is something that is just, at the forefront of the commodity space, and something that where we see that, even if it's a small amount of notional that's being allocated to these frontier markets, that is kind of where, you'll see investment for the next, decade or so. And then, last note is that when you have people that are excited about new things, and that also brings interest to some of the old institutions, right? And so, again, given the sort of inflationary environment and sort of all the focus on, rising interest rates, it's not uncommon that we would think to see, further investment, sort of growth around the more traditional portions of the asset classes, right? So thinking about your oils, your agricultural. So it's a very exciting time. It's kind of the gist. Okay, so then very briefly, if to touch base, so that is kind of how we see the universe expanding, right? And so we always talk about this on our desk in this sort of access where you have, market access and sort of new things that can come in scope on one side, and then you have sort of complexity and strategy creation on the other. And so, a very common idea might be you take what is sort of existing in the current literature, the current body of work that's marketed in, like we said, has hundreds of billions of dollars, and you just try to extend that to some of these new markets and see what sticks. But and that is something that we do. However, I think that where we want to also think and where there's a lot of value that quant finance can add is how can you make the strategy set better and can you add something that is more unique? Because like the honest answer is that a lot of what is offered, I think, at least from the sell side to the buy side as the clients, and not just sort of used internally, there's definitely some overlap. And so where we see sort of the advent of the strategy space going, we try to highlight here and sort of give what we think is mature and where we see the growth areas based on these two main veins. So if I think that there is a major, obviously, predominant presence of that risk premia and that factor money in commodities and FX, like we said, I would say that probably the second major ways that we actually see risk being deployed is this kind of like this observational bucket, which can really be boiled down to this concept of just some form of conditional probability. And you would be shocked how often and how even the most advanced people that have all the PhDs, that how frequently they will just trade something because it happened in the past. And if they can get behind why, at least looking for some confirmation bias that there's nothing that's antagonistic to that thought process, they'll do it again. And so where we think that the growth can be here is that, well, maybe you take a little bit of that ex post framework and you instead try to make something that is a little more ex ante and predictive. And so when I think about a lot of the risk that goes on in the macro space, at least in commodities and to some extent in FX, there isn't a lot that goes on that is very forward-looking. A lot of it is predicated on sort of these concurrent factors and these signals that are generated, or they're looking at something fundamental like carry, for example. And those tend to do very well. But where I think that there's probably room for improvement is that you take some of those advances in technology, those advances in algorithms and computing ways, and you try that I think have been successful in equities, honestly, much more, and you start to try to move it and migrate it over to the macro space. I think it's been hard for a while. Some of those buzzwords around like the machine learning, I don't think does as well in the commodity space and maybe more generalized to the macro world. But specifically in the commodity space, and especially on a relative basis. And what I mean by that is that when you look at the added sort of, out of sample or in sample risk adjusted performance that adding more complexity gives you, we have not really found that there is a lot in the commodity space. And so the hope is that as you see some of those themes about investment and coming into commodities and effects, that you'll see a greater dimensionality to the data, which I think is going to be supportive. You see more underliers, which I think gives you a little bit more of that fungibility, which you find in equities, which allows you to create that portfolio of 100 long short pairs. And that you start to see a little bit more of that quant resourcing, I think, become useful versus these more slower fundamental strategies, which have persisted for years and are great out of sample, but honestly could be a little staler. The second version, and it's kind of the last point, which I think is actually one of the more interesting, is that risk premia, as in general, centered in factor investing as well, centered on the idea of you take one signal to represent something and you diversify it out as much as possible, whether that's across asset classes or intra-asset class. And so the idea being, you can capture trend or value or carry, let's say in the commodity space, you can take that same signal and apply it, across all major underliers, right? Let's say all 30. And so that gives you, once you do that enough times, a portfolio that honestly, I believe sort of has a marginal, diminishing marginal contribution of what each next strategy does, in the sense that what you end up doing is sort of getting periods where things are netted out, or you get periods of sort of hyper leverage where all of your signals are going the same way. And instead of that, something that we've been positing, I think, is, rather than look at that sort of one-to-end mapping, is there value to instead trying to make an end-to-one strategy where we take one idiosyncratic pair, whether that is, the oil arb of kind of like Brent versus WTI, or you take the yen franc, which are two haven currencies, and you instead try to map that using as many approaches as possible, but that are unique to that pair from both a technical or quantitative, fundamental basis, whatever it may be. And instead of this kind of like very discrete weight shifts in the portfolio, you get more of a continuous path of how someone would actually trade it if they were sitting in the seat. And this was interesting because we were actually at one of the largest endowments in the world. It was one of our clients last week. And one of the things that they were bringing up was that they were looking in particular to see if we knew someone that traded just milk as like a hedge fund, kind of like Millennium Pod. And their thought process was that, they've added as much diversified exposure as they want. They have, risk premium, they have equities, they have, private equity. So the next kind of incremental unit that they were looking to find is like someone that really focuses on one thing and can add value that is, completely orthogonal to everything else they do. And so that really strikes home because what you can see maybe as an extension of this is if you have that person that's kind of in vogue right now and that person that looks only at 2 to 3 markets, can we in some way codify or quantify exactly, or at least 90% of, what it is they do? And can we replicate that and make that, investable to a wider and a more far-reaching audience, and also put it in a framework that can support a much higher notional allocation? So that kind of like one-off trading, I think, is something that's going to be very interesting that you don't see a lot of, but it is a way definitely to sort of, distinguish the space and kind of, I think, where you start to see some of the specialization occur, whereas the past decade of, quant trading, I think, in general, has been really defined by a lot of generalization and a lot of diversification. So that was very high level, and I hope trying to make the time slot. So I will pause it there and answer any questions. And if not, thank you all for the opportunity, and it was great to be here.
Max, as always, it's just wonderful to have you here and to listen to you. Could you speak a little bit more, if you go back to I think it was the last slide, but yeah, so as you went through our program, so you know kind of what we do. So how would you, as a student today, focus your energies in terms of what techniques and tools would you want?
Sure. Yeah, it's a great question, and something that I spend a lot of time now on in terms of hiring for our team and others. And I think that the amount of talent out there right now at sort of all levels, but especially at kind of the more junior in the quantitative spaces, is probably the highest it's ever been. I mean, you have people that are proficient in every language that you need, and all the newest technologies and sort of models. But what I think has been sort of dictating sort of the most recent success that I've seen is that people that are able to communicate, like the keynote speaker sort of mentioned earlier, but communicate ideas, but also I think through and innovate a bit more versus sort of just being told or being able to deliver well is really important. I'll give you actually an example. We had someone that joined our team that was not a sort of traditional hire. Obviously our normal vein is, very heavily quantitative, very technical, usually some form of master's, but they came sort of as an internal with a background in philosophy from a very prestigious school. And it wasn't so much that we had to send them and sort of get them caught up to speed on some of the technical portions, but I think the ability to sort of approach a problem in a unique way, in a different way, and then be able to articulate that succinctly and well into all levels of audience, right? Whether it was to me, and so I could maybe understand his thought process a bit better, or if it's to a client or some global head. That I think was a really underappreciated skill set that is hard to develop. At least when I was here, especially in the undergrad, is something that I wish I put a little more, time and attention to, because I think that's something that it's very hard to get without that live practice. Other than that, we're seeing that the more everyone again is so talented that the more that you can sort of set yourself apart. It doesn't even have to be with results, because I think that that is so often a function of kind of like how you got to where you are. But if you can demonstrate why your story, is applicable to whatever it is you're looking, that's proven to be, I think, the most successful in landing internships, analyst and associate roles. That's really resonated the most with all forms of hiring committees, at least at B of A. So.
Great, thanks. I think you do have a question in the chat.
Oh, so the towards synthetic assets. This will cause extreme liquidity and decay of traditional. That's a great question. So the idea being, if you move more, kind of in vain to like the frontier being pushed out, do traditional asset classes, I think, sort of erode, and do you see current trading strategies kind of, fade away? It's a great question. I think that even with sort of the advent of a lot of these, less traditional assets, you will still see core investments, at least, for the short term, persist. I mean, if I think about the last 2.5 years, especially coming out of COVID, and how prevalent like crypto has been, for example, FX notional trades that we've seen have actually gone to their all-time highs, both for our side as well as from what I've heard about volumes across the street. And I think a large part of that, at least in the macro space, is that, again, the reason why people trade these is because they have needs, right? Like the idea is that if you have a very large equity portfolio, which will again persist to be the core of a lot of allocations for at least a while, you have to have ways of managing that, not foreign currency exposure. You have to have ways of protecting against inflation, and so that will always still provide opportunities in these more traditional asset classes. And then I think to sort of further it is that if you look maybe 2 decades, 3 decades, however far, I'm no longer even in charge of of our team. We're gone from the bank or finance. That maybe you start to see, I think, kind of a real paradigm shift to where the landscape is dramatically different. I mean, if you looked even at the thinking back to the keynote again of how things have evolved. I mean, it's almost not recognizable, right? But in the short term, I don't think that there was enough liquidity in these synthetic assets to justify large institutional investment at the moment. And so that's when, so I had the phrase of like economic or meaningful economic notional in return. If you have $100 billion of cash, which is not, uncommon, or, of leverage exposure, you can't put that all into something that is, still being built out right now, right? It just won't pass your investment committee. And so even if that could be, where the yield is, you're still gonna find restrictions, right, in place until it becomes a little bit more streamed. And then, as we move through time, maybe no one will hold stocks in 20 years or 30 years or whatever it may be. But for now, I think that that interest is going to help push some of those more traditional asset classes to maybe rethink how they're doing things and to maybe innovate a bit better so that they can compete. So that would probably be my 2 cents on it.
Yes, I'm actually teaching a financial optimization class and the students are actually constructing their first portfolio. And I
cool.
asked them to use, government bonds and SPM 50 assets. What other assets should they include to make it more realistic and more challenging?
That's a great question. So what should it be? So if you have kind of, government bonds and the S&P, you're not really looking at a ton of FX exposure. So then I think the idea that, we should start to think about is, and maybe I can go back. Oh, I don't know. One of the ideas to think about is, what are the kind of then the risks that portfolio has? And then naturally, is there some form of hedge that can be expressed in a long format? Because that also tends to be a big inhibitor, right, of a lot of strategies or sort of mandates, is that you can't necessarily have short leverage in it. So if you can find a way to protect against, some form of that risk, then maybe you have the small allocation. And so commodities, when I first started, I left Rice, I guess I started in 2015, as an analyst. The majority of the notional that we saw from the long only front was mostly just that, again, those small inflation hedges. And people weren't really worried at that time, obviously, as they are now, but that kind of, drove it. And so maybe you start to add the 2% there. And then if you can find, some form of investable format to benchmark, a little bit of a yield enhancement. So you go to find like a private equity index. That I think is very common to how you start to see, the endowment pension funds of the world. sort of allocate their resources, where they have their liabilities and their obligations sort of met by that core bond, and with a little bit of capital appreciation in the S&P, and then they have the 5 to 10%, which there's a little bit more flexibility. So I think that a little bit of commodities, the BCOM index is a very common one. Gold, more specifically oil, and then if you can find some private equity, maybe you have like a small rates play, and then of course, if you want to allocate a little bit to a risk premium bucket, I think there is some benchmark indices that are published by Bloomberg that kind of replicate that total return alpha, and that could be another good 5 or 10%.
Can you imagine Mr. Lee in another 30 years? Just incredible. What do you use for benchmarks in a commodity system? Do you use CRB or the GSCI index or a random trading system?
It's a good question. So from a long-only perspective, commodity benchmarks are actually most referenced by BCOM, which is the Bloomberg Index, which was previously owned by AIG. And that's mostly as a function of liquidity. I'm sorry, sort of diversification. So the GSCI index owned by the S&P is very oil heavy, and so that tends to present, obviously like in the current environment, very high volatility. So the BCOM index tends to try to approximate a little bit more of a 33% split across energy, metals, and call it agricultural and soft. So that is the most common. And then from a total return perspective, a lot of times people look, it depends on the factor, sort of like what the risk premium bucket is. But then the general gist versus the most common strategies, which are carry and sort of liquidity, which are calendar spread oriented, they are very low vol. And so because of that, you have a low vol instrument that is either replicated with a margin instrument in commodity futures or traded in an unfunded format. If you have to post zero sort of initial margin to either to the dealer, or you're getting charged very low initial margin from the exchange because they give you that correlation benefit, a good benchmark, honestly, a lot of the times there is cash. And so when you're in a world where cash is returning 0% or negative, it makes a very attractive reason to try and go find a way to put that. Either if you have an ISDA in a low vol strategy, or something that we've seen that it's extremely or that was extremely popular last year was, especially in the EU, people were in essence buying physical EUA credits and taking those to delivery, and so delivering it back to the exchange and capturing that yield, right? Because that's an ARB in essence. And so even if that, once the dealer would quote it, even if that's slightly negative, if your Euribor is minus 55 bips and you're gonna have to pay to hold that cash, that you can find something else that's risk-free that you deliver. It's a smaller cash drag. That's also another very popular way. Oh, is this the BlackRock question? So good. So with BlackRock now investing in and owning over 10% ownership of Ethereum infrastructure, do you think that timeline would be accelerated? So I'm not a crypto expert, so I will have to defer or do a little research on that. But what I will say is that when we've seen large, sort of very popular asset managers own a large portion of sort of infrastructure or pipeline in, again, a frontier market, it still takes time to, I think, accelerate the rest of the institutional space as well as the retail space, because you sort of have to have buy-in, right? And so a lot of times the name itself just isn't necessarily enough. And even if they have, the X trillion dollars on their assets, I think you still eventually have to have buy-in from a wider a bit of the street. And there's honestly an opportunity to be a first mover advantage for sure, and that generally tends to pay very well. Or go very poorly in finance. But if you know what you're doing, I think that there is definitely an opportunity to sort of be there. And then if you notice that there is a large, you said, sort of well-established, recognized figure in that space, that actually could be a sign that that's the right place to look, versus maybe something that's completely more esoteric with 10 people in it. But that would be my sort of roundabout answer. But I cannot opine explicitly on the Ethereum question.
Okay, so let us take next.